Welcome to the Coin Bureau Weekly Crypto Review. Here are this week's top headlines in the crypto news. Crypto rally continues. BTC blows past 23k, while bulls and bears debate where crypto prices are headed next. What was the cause of the recent rally, and when will the correction come? What the FUD? The crypto community breathes a collective sigh of relief after the DOJ announces it's going after a niche crypto exchange. Here's why the real FUD could be much more terrifying. Ethereum's new uncertainty. Developers reportedly consider delaying withdrawals of staked ETH as the highly anticipated Shanghai upgrade approaches. How could this impact ETH's price? Bearish catalysts incoming. Genesis officially files for bankruptcy, crypto banks face scrutiny, and VC investors prepare for over $100 billion of vesting. Everything you need to know. Job cuts intensify. Big tech and big banks announce mass layoffs amid rising interest rates and economic uncertainty. Does this mean the Fed is about to pivot? And some words of wisdom from the one and only Mr. Benjamin Cowen. All this and more in just a moment. Good morning, afternoon, or evening. Thank you for tuning in. My name is Guy, and what you're about to see is educational content, not financial advice. You can find any topics you're looking for using the timestamps in the video timeline. And now for today's top stories. Last week, the crypto market continued its epic rally, with Bitcoin leading the charge. The total crypto market cap exploded past $1 trillion as coins and tokens hit their highest price points in months. According to CoinGlass, over $300 million of short positions were liquidated. Now, this pales in comparison to the billions of dollars of short liquidations in the previous week, but the short squeeze effect was the same. Traders who bet that the crypto market would go down had to buy the cryptos they bet against to cut their losses, and this buying pressure contributed to the rally. The crypto that rallied the most out of the top 100 was Aptos, rising over 60% in the last 7 days. This rally appears to have been due to a combination of a short squeeze and the popularity of Aptos in Asia, specifically China. Yesterday was Chinese New Year, and this could have played a role in APT's pump. Besides that, there don't seem to be any crypto-specific factors that caused the market to move higher. There's been speculation that whales are manipulating the markets to cash out. This is because many of the altcoins that pumped the most have VC unlocks coming up. More about that later. Now, as most of you know, the crypto market is highly correlated to the stock market. As it so happens, the stock market has been rallying over the last few days as well. This is because investors are expecting the Fed to signal that it will be pausing or lowering interest rates at its next meeting on the 1st of February. Investors have this expectation because central banks have ultimately been raising interest rates to fight inflation, and inflation has been coming down in recent months. The thing is that central banks seem to believe that tight labor conditions could lead to another wave of inflation. More about that later too. In any case, it's quite clear that the crypto market is getting overheated. Although there was a bit of a correction last week, most cryptocurrencies are now substantially overbought on longer-term timeframes, not just short-term timeframes. Not only that, but there seem to be some divergences forming. BTC's price is poking above the Bollinger Band range, and the RSI is over 80 on the weekly. Both are signs that BTC is overbought on the long term. Meanwhile, BTC's trading volume has been declining while its price has been rising. This divergence between price and volume suggests a reversal is coming. Now, the caveat is that the two lines on the MACD are still fairly far apart. This means we could see another week or two of positive price action before a real reversal occurs. You can learn more about how to spot local tops and trend reversals by checking out our technical analysis tutorials in the description. Now, as I mentioned a few moments ago, there was a small correction in the crypto market last week. This was caused by the sudden announcement that the United States Department of Justice, or DOJ, would be announcing a, quote, international crypto enforcement action in a few hours' time. Crypto Twitter immediately started to speculate which crypto company the DOJ was after. Many suspected Binance or Tether, in part because both have faced scrutiny from US authorities before, and in part because Sam Bankman-Fried may be sharing sensitive information about both with authorities. More about that in the description. I digress. Now, this speculation turned to terror when Binance CEO Changpeng Zhao tweeted the number 4. For context, earlier this month, CZ tweeted a list of things that people should focus on, and number 4 was ignore the FUD. Naturally, crypto Twitter assumed that CZ was confirming that Binance was about to get hit. The crypto market immediately started to crash until the DOJ revealed that the crypto company it was cracking down on was a random Russian exchange called Bitslato. Now, Bitslato allegedly laundered hundreds of millions of dollars using cryptocurrency, and yet even crypto OGs didn't know the exchange existed. The crypto market immediately shrugged off the FUD and continued to climb, but it seems that crypto traders haven't been paying close enough attention to the headlines. As reported by Cointelegraph and others, Binance was one of Bitslato's top counterparties, at least according to US authorities. To be clear, this doesn't mean that Binance was involved in or even aware of what Bitslato was up to. Indeed, Binance may even have been instrumental in providing the information required for the feds to take down Bitslato. Be that as it may, this whole episode does underscore the fact that crypto exchanges and companies have been facing extreme scrutiny ever since FTX and Alameda collapsed, and that more enforcement actions could be coming. It's important to point out that this scrutiny doesn't just apply to centralized crypto entities either. The United States Securities and Exchange Commission, or SEC, recently claimed that Mango Markets' DeFi governance token is a security, meaning it needs lots of regulation. Now, while this claim was made in a multi-million-dollar lawsuit against the infamous Mango Markets exploiter, it nonetheless suggests that the SEC has its eyes set on crypto projects as well as companies. Consider that half of the SEC's crypto enforcement actions in 2022 were against crypto ICOs. The silver lining is that the SEC likely won't make a move on any large cryptos until its lawsuit against Ripple has been resolved. Ripple CEO Brad Garlinghouse recently said that the lawsuit will be resolved by June. Until then, be aware that every crypto besides BTC is fair game for the SEC, including, God forbid, proof-of-stake ETH. Speaking of which, some Ethereum developers are reportedly considering delaying withdrawals of staked ETH to a later Ethereum upgrade. For reference, withdrawals of staked ETH were expected to be enabled with the Shanghai upgrade, which is tentatively scheduled for sometime in March. As almost all of you will know, Ethereum initially launched its proof-of-stake beacon chain way back in December 2020. Since that time, 16 million ETH worth over $25 billion have been deposited into the staking smart contract, and validators have been unable to claim rewards or withdraw their stakes. As explained by Decrypt, Shanghai is still scheduled for March, but a small group of Ethereum developers believe that ETH withdrawals should be delayed. This is basically because the way ETH withdrawals will be coded will require all the ETH withdrawal code to be rewritten at a later date. To be exact, Ethereum developers were planning on allowing ETH withdrawals with the Shanghai upgrade using code that will have to be rewritten as part of the Cancun upgrade later this year. This is not ideal, but most Ethereum developers argue that delaying withdrawals would be much worse. Conversely, a small group of developers argue that rewriting the original withdrawal code will not only take lots of time and effort, but could cause technical issues and exploits for Ethereum further down the line. As such, they believe withdrawals should be delayed until the final withdrawal code is complete. Now, if I understand correctly, Ethereum developers are currently planning on proceeding with the original plan, which is to allow ETH withdrawals using code that will have to be rewritten. This is good news for Ethereum stakers who've been waiting for over 2 years to withdraw, but it could be bad for ETH. Take a second to consider that ETH's price was around $600 when the beacon chain launched. This means that early ETH stakers are sitting on massive profits of almost 3x that they probably will want to cash out. It's a little bit more nuanced than that, but I'll explain in my Ethereum update later this week. Now, at the same time, there are many ETH stakers who are holding on to massive losses and are desperate to cash out to meet debt obligations and whatever else. Lots of this kind of sell pressure could come from exchanges, given that they're some of the largest Ethereum validators and are strapped for cash. The good news is that there will apparently be limits on how much ETH validators can withdraw each epoch, which should limit any sell pressure from these entities. The bad news is that we're currently in a crypto bear market, and that means even a small amount of consistent selling could impact ETH's price. The catch is, of course, that ETH could see a short squeeze from leverage traders if its price fails to plummet after withdrawals are enabled. I suppose this ultimately depends on what ETH's price looks like at that time, and that is really anyone's guess. Now, one reason that I remain skeptical of this current rally is because crypto fundamentals haven't changed. In fact, they've only gotten worse. Crypto trading firm Genesis has finally filed for bankruptcy and reportedly owes anywhere between $1 and $10 billion to creditors. You can bet it will be selling whatever assets it has. More importantly, the implosion of Genesis suggests that its parent company, Digital Currency Group, or DCG, could be the next domino to fall. As some of you may know, DCG owes $3 billion to creditors, and CEO Barry Silbert has been using his restructuring experience to prevent its bankruptcy. It's possible that allowing Genesis to go under was part of Barry's plan, but then again, it's only added to the sense that DCG is in deep trouble. Additional evidence can be found in the news that crypto news site CoinDesk, which is owned by DCG, is up for sale. The asking price is apparently $200 million. Assuming the rumors on crypto Twitter are true, then CoinDesk may be acquired for a lot less. This begs the question of how much DCG's $500 million VC portfolio will be worth to buyers. I bet it won't be $500 million, and that means DCG may not be able to acquire the capital it needs to stay solvent. On that note, you may recall that crypto bank Silvergate recently experienced a bank run. It's now been revealed that Silvergate had received a $3.6 billion loan from US home loan banks. The loan was reportedly given in Q4 last year when Silvergate rushed to honor withdrawals, which is not a good sign. And Signature Bank also received a $10 billion loan from US home loan banks in Q4 2022. What's concerning is that Signature is being used by Binance for SWIFT bank payments, and Signature recently set a minimum limit of $100K for USD SWIFT transfers, citing its desire to decrease its exposure to crypto. Now, regardless of the reason why Signature made this move, the fact that crypto banks have exposure to the US housing market is likely to result in heightened regulatory scrutiny. Imagine a scenario where a crypto bank can't repay its loan to home loan banks. That would be an instant crackdown in my book. If that wasn't bad enough, cryptocurrencies that were heavily funded by venture capitalists, or VCs, are scheduled to experience 2023 token unlocks totaling $102 billion as per reporting by CryptoSlate. Make no mistake, the sell pressure coming from early investors will cause most of these cryptos to tank. This is why it's hard for me to believe that the current crypto rally is sustainable, and why I still see lower lows coming for the crypto market in the short to medium term. It's also the absence of bullish catalysts such as the MiCA crypto regulations in Europe, the release of which has been delayed to April. More about MiCA and other upcoming bullish crypto catalysts in the description. Now, I'll remind you that it's not just crypto-specific factors that could move the market in the coming months. There's no shortage of macro factors that could do the same, and the most significant is, of course, the ongoing interest rate increases by central banks, especially the Federal Reserve. Rising interest rates have the practical effect of making existing debt more expensive and making borrowing even more difficult. Logically, this means that industries that are most reliant on debt funding, like housing and technology, will be the most affected, and this is exactly what we've seen so far. Last year, big tech companies started reporting significant losses of revenue. Now they're starting to cut jobs, and they're not cutting any corners. Google recently announced it would be laying off 6% of its entire global workforce, which is truly unprecedented. In terms of raw numbers, that's 12,000 people. This is not far off from the 5% workforce cut that Microsoft is in the process of performing. In Microsoft's case, the headcount is closer to 10,000. Amazon also announced it would be firing 18,000 employees, but this is just a fraction of Amazon's total workforce in percentage terms, for now. If you watched our video about the Fed's most recent minutes, you'll know that the central bank is concerned that the ongoing labor shortage will cause a resurgence of inflation. This is simply because a labor shortage means that employees can ask for larger paychecks, and this means more spending. This is why Fed Chairman Jerome Powell has been so obsessed with bringing the demand for labor back in line with the supply of it. In practical terms, this means creating a recession to increase unemployment, which is why investor consensus around an upcoming recession is at record highs. This is also why the news that companies of all kinds have been collectively laying off hundreds of thousands of employees has been paradoxically positive for the markets. The thing is that these layoffs have been concentrated in the most interest rate sensitive sectors, namely technology. In other areas of the economy, the labour market is still extremely tight, with the average pay raise being well above the Fed's inflation target of 2%. This means that the Fed will have to continue raising interest rates and keep them higher for longer until the rest of the economy reacts, and this could take months. Unfortunately, investors do not seem to be pricing in this reality, which could make the revelation that much more painful. Then again, I'm no macro analyst, so I could be completely wrong here. Still, my research for an upcoming video about governments defaulting on debts tells me I may be onto something. Stay tuned for that video. And with all that said, let's now get the thoughts of Ben Cowen as we head into another week.
Hey Guy, thanks again for having me. As always, it is a pleasure to be here. I first wanted to start talking about the Fear and Greed Index. This is something that a lot of people in crypto follow, but it's interesting because we actually just got back to a neutral level. So the Fear and Greed Index now sits at 50. Now, something that I thought is potentially worthwhile to follow is this of course is color coding the Bitcoin price by the Fear and Greed Index. And one of the things you'll notice is that it can actually stay in the Fear and Greed like 90s for a long time, right, during a run-up. It can also stay in fear for a long time during a bear market. And so one of the things we can do is first we're going to remove the color and just look at the raw value of the Fear and Greed Index as a function of time going all the way back to 2018. But one of the things we can do as well is to actually take a moving average of it, like a 30-day simple moving average. And this probably does a bit better of a job, at least of sort of identifying where are we getting to that sort of that peak level of fear and that peak level of greed. Rather than just sitting at 95 for 3 months, you can see that it actually takes quite a long period of time to reach some of these extreme greed levels and then to sort of slowly trickle down as you go through this distribution phase. But really, the fear and greed index, say like the 30-day SMA of it, has been slowly moving up for a while, and most recently it actually did get to that 50 level. In order for us to take out, some of the recent highs that the fear and greed index went to back in March of 2022, it went all the way up to 60. Right now, it sits at about 50. So just something to think about as we continue to go forward with Bitcoin. The other thing I wanted to briefly talk about is the balance price and the realized price, because this was something we followed in the past. One of the things you'll notice is that Bitcoin often spends a significant amount of time between the balance price and the realized price during these phases, right? So if you go back and look at 2011, you can see that we were in this range for a while. We actually had several daily closes below the balance price. And you go look at 2015, you'll see a very similar thing, right? Daily closes below the balance price. But really the main view here is we just spent a long time between the realized price and the balance price. And then going back even further into 2018, same thing, right? A few daily closes below it, but we spent many, many months in this range. And actually we spent a lot longer in this range back in 2015, because in 2015 we first entered it actually in December of 2014. We didn't really leave it any sustained way until almost a year later. So about 10 months later, we did poke our head above it a couple times, right? I mean, maybe three times or so, where we went into the range and we poked our head above it, only to then fall back into it. And it sort of just makes you wonder, where is it today? It fell into this range back in June. So we've more or less been in this range or slightly above it for about half a year or so. Okay, so last cycle, it was only about a few months. Cycle before that, it was like 10 months. So far, it's about half a year. So, this is one of those things that when it's in this range, doesn't mean it can't go, doesn't mean it can't go lower, as many investors learned back in August, right? This was sort of one of those false breakouts where it rallied on up to 25K and it was above the realized price, and then it just sort of slowly came back down and eventually put in a new low. So right now, the range of the realized price and the balance price, which has sort of been the range that Bitcoin has been in prior bear market, at the end of bear markets and in the accumulation phase, currently that range is from 14.46K up to 19.79K. So more or less around 14.5K all the way up to 20K is sort of that range between the balance price and the realized price. And right now, Bitcoin is above the realized price. For it to go back below the realized price, we would have to go, just a bit below 20K this week if it were going to happen. If, of course, it happened in several more weeks, the prices would obviously change. And then the other thing I wanted to briefly talk about is this portfolio simulation type thing. So if you think about a lot of crypto investors like to spend a lot of time figuring out, how are they going to weight their portfolio? Do you weight it by market cap? Do you weight it equally? How do you weight it? And of course, none of this is financial advice, as everyone should know. But just as a useful exercise, if you were to go weight, by the top 10 cryptocurrencies back in say, April 15th of 2020, which is right around that, that major low that we had back in, right before everything took off, you'll see that the top 10 cryptocurrencies at the time. And what's interesting, whether you weighted it by market cap or the square root of market cap, note that taking the square root means you put less into the larger market cap project. So just weighting it by market cap would have been 74.5% Bitcoin, 10% ETH, so on and so forth. Square root of market cap gets it down to 39% Bitcoin, 14.5% ETH, so on and so forth, versus the natural log, which is almost an equal valuation, or versus just doing it equally. What you'll notice is no matter how you weighted it, while sometimes it would have, you would have seen different levels of performance, as of today, all four portfolios, had you started off with $1,000 of an initial investment, would all be worth somewhere between 4.14K to 4.49K, right? So it really shows that, despite all the exercises in portfolio rebalancing or balancing, trying to balance it in different ways, whether it's by market cap or an equal allocation, it really does go show, at least over the long haul here, over the last cycle, the end result as of today would essentially be the same, right? It wouldn't be that much different. Where it does become different is in major run-ups, because at various phases, Bitcoin can outperform the altcoin market, or altcoins can outperform the Bitcoin market, and so that's just something to consider. But this is maybe useful for someone to look at if they're trying to figure out what strategies they want to take on. Just kind of look back and see what strategies would have worked in the past, and where would they have stood today had you held on to that strategy for 2 or 3 years. But anyways, thanks again for having me. Pleasure to be here as always, and I'll see you again next time. Bye.
Thank you, Ben. And don't forget, folks, that Ben will be hosting Rob from Digital Asset News and yours truly on his channel this week for Not Financial Advice, our weekly live stream show. Thursday at 9 a.m. Eastern Time on Into the Cryptoverse. I hope you can drop by. And that is all for today's Coin Bureau Weekly Crypto Review. If you enjoyed it, you know what to do. Hit that like button, subscribe button, and bell icon too. If you're looking to maximize your gains during the bear market, the Coin Bureau Deals page is where you should go. You can find the link to that resource and many others in the description below. Thank you so much for watching, and I will see you all in next week's episode.